Okay, thank you so much.
Hello, Ashish. Hello,
And
Alex.
here's the
Napur.
last of the links. That should get you to everything that we've had historically, at least 23 prior.
And Glenn, I may have to contact you about a couple of videos that I seem to be missing. I'm missing David Zook's video, for instance.
Okay. Uh-huh.
I think it's published on the Intel site. So
Those are available for a modest fee. Yeah.
yeah, we can negotiate it.
So the
So
one
there's
from last week is there already?
The one from last week is up on alternativeinvestingclub.com, Speaker Hall of Fame.
I don't know if that was it. Oh, it looks like David.
It's right there.
Wow.
Lots of links in the chat right now for people that are joining.
Awesome. Thank you.
All right, we're starting to get some people in here. I don't see the speaker yet, though. Hello, Brooke. Hello, Alex. Hello, Karthik. Thornton.
Hello, Daniel.
Hello, Colette. You're new to the group and soon to be a future speaker.
Hello.
Hello.
I'm in the car driving home.
Okay, be safe. All right.
Hey, Daniel, quick question.
Yeah.
Because last week you said that you would like for us to share the group to others who'd be interested in this. Do you mind putting the link that you would want us to send to folks in the chat?
Yeah, right now it's basically the Zoom link. Let's see. So if you share Alternative Investing Club, actually, let me share my screen and just walk through this here. Put the link here. Alternative Investing Club, hashtag events. So if you go to this link, you'll see the Alternative Investing Club, and it'll bring you down here to the schedule of speakers, where you can see who the current speaker is. We have Eli Wiener today on Invest in a Business That Even an Idiot Can Run. And he's done quite well with it. And then we also have the upcoming talks here. Jeremiah Boucher, Finding Your Edge is next. Sam Wilson, Recession-Resistant Asset Classes. Prolette, who's currently here in the group. From tech to financial independence to real estate. So you'll see, the upcoming list of events, up to 5 events out. And then if you just click on register to attend, it'll bring you right to the Zoom link, which you could go to directly if you want as well. But yes, I would definitely appreciate it. If you have gotten value out of this group, please go share that link. Send it to somebody who could use it. I'm looking to grow the group and to continue to bring in great speakers.
All right. Thank you.
I highly appreciate that.
All right. Thanks, Daniel.
All right. Did our speaker join?
Yeah, I'm here.
Oh, there he is. Hello, Eli. Do you go by Eli or Elias?
Eli Weiner.
Okay. My apologies. Eli Weiner. All right. So now that we got through with the obligatory share the show comment, I want to welcome Eli to our group. I was introduced to you through Ashish. Thank you very much, Ashish, for the contact. And Eli is going to come here and talk to us about invest in a business that even an idiot can run. So Eli, I'll just turn it over to you. And if you have questions, please put them in the chat. I'll interrupt Eli on a periodic basis. And am I saying your name right again? I'm having a brain freeze.
Yeah, Eli.
Okay, yeah. Thank you. And so let's get started.
Okay, great. Well, thank you, Daniel, very much for inviting me to speak at this on your program here. I appreciate it, and hopefully I can bring some value to you guys. Can everyone hear me okay? Okay, wonderful. So it was funny when what's the title to what you want to talk about? And I'm a little bit unoriginal, really. So that invest in a business and an idiot can run is basically a Charlie Munger. It's a Charlie Munger saying, and it really just talks about businesses that are so good you can make some mistakes, or the operator could make mistakes, or, but over a long period of time, because supply and demand is so much on our side, that you end up winning. And that to me, so when I heard him first say that, I thought about mobile home parks, because I've bought a lot of mobile home parks from operators that were not great. And they, whether they were undercapitalized or bad at the dealership side of the business, we're going to kind of go into that type of stuff, but they still made a ton of money selling to me, because there is still so much more meat on the bone. And so anyway, I think about that, invest in a business, and an idiot can run, because at some point an idiot will run it. And I think they were talking about, maybe a 10 years kind of flat point with Coca-Cola. And but over time, it's the compounding effect of a good investment. It's kind of unbeatable. And compound interest, Albert Einstein repeatedly said, is the most powerful force in the universe, right? So if you have that type of good business, and you hold it over long periods of time, you're going to get that type of compounding. So let me go into a little bit of our business and who we are. So I founded the Boita Group in 2017. But I've been buying mobile home parks. I'm 45 years old. I've been buying mobile home parks for about 23 years. So the Boita Group has basically, we own and operate about 250 mobile home and RV parks across the country, coast to coast. It's just under 27,000 spaces now. So every month we're closing deals, so that number kind of changes. But so just under 27,000 spaces. And I wanted to kind of get into a little bit of, mobile home parks. So there's different things that you guys, I'm sure, have heard. You've heard trailer park, mobile home park, manufactured home community, RV park. And then there's different types of RV parks. So let me run through that a little bit. So I'll give you an example. We bought a park in Gardena, Southern California. That is a trailer park, tiny spaces, probably built in the 60s. We went in there, we fixed it up, we did new streets, we made it nicer. The rents were super low. But at the end of the day, we made a 1.5 star, a 2-star park. It'll always be a trailer park. And then we have mobile home parks, where you have just kind of a nice layout, pretty typical, that you guys have probably seen many of, double wide, single wides, but 100% mobile home. And again, we want to buy those, increase the experience for the residents, and fill any vacant spaces, and get rents to market. So, and then you have what I call a manufactured home community. This may have a lot more newer homes. It may be gated. It may be a senior park. It may be the homes might be set up in a way where they don't look above the ground. So we call that pit set. And they may have attached garages. So we have several communities with attached garages. So very fancy manufactured home communities. So, and then there's RV parks. So we got into RV parks several years ago, mostly focusing on, there's two different types. There's a long-term extended stay RV park. And we were able to buy these RV parks in places. So I'm in Sacramento, California. And in Sacramento, we own several long-term extended stay RV parks where traveling nurses will live there for 2 years. People, contractors will get jobs for ongoing jobs, and they'll need a place to stay, and there's just nothing there. So they'll buy an RV, move the RV in, and actually pay higher rents than they would in a mobile home park. So and all the utilities are passed through. We operate that type of park just like we would a mobile home park, where they pay their water, their sewer, their trash, their gas, their electric. Everything is sub-metered, which is the goal, by the way. When we buy these parks, a lot of times they're mom and pop operated, and they don't want to spend the money to pass through the utilities. So the real goal is to buy these and pass through all the utilities, fill every space, get rents to market, fix all the major problems with these parks, because a lot of times they're just band-aiding stuff. I have this thing in the room behind me, big conference room that I never erase it. It says no more band-aids. So we go in there, fix it. Once you fix these infrastructure issues, it's off the P&L, for hopefully the next 25 years. So so you want to come in, well capitalized to do that. But so there's long-term extended stay RV parks. We've done fantastic with those parks. In 2008, really 2017 was the first time I bought a high-end destination RV park, and that was in Southern California in the desert called BGO Springs, and it's the Springs RV and Golf Resort. Unbelievable park. I was so scared to buy it, and I tried to flip it to I tried to actually get the broker to buy it from me that was selling me the deal. It was a $27 million deal. The 400 space mobile home park, we priced it $24.5 million, and the RV park we priced at $2.5 million. Well, that was actually closed at the very end of 2017, which was good because that's right when the tax laws changed and we were able to get all the accelerated bonus depreciation. It was kind of an amazing deal. That broker, and we'll get into this, but that broker ended up reinvesting his $500,000 commission on the deal. And because of that accelerated bonus depreciation on his K1, he had a $1.2 million loss. So he basically made his money back just with that one investment because of that accelerated bonus depreciation, because he was a qualified real estate professional, owned other parks, and could use that right off 100%. So, but the point is, just a couple years ago, we refinanced that RV park, just the $2.5 million high-end destination RV park. We also built out another 40 spaces, so now it's 200 spaces instead of 160. And but it's performed so well that it actually came in with a $21 million value, just the RV park. So that kind of blew my mind. And the thing's cash flowed like crazy. We actually returned 100% of the money back to investors just through cash flow without even doing that refinance in just under 5 years. So that was really a cool deal. And that kind of got me thinking in 2018, okay, let's start Boa Vida. So Boa Vida Communities manages the mobile home parks. Boa Vida RV Parks and Resorts manages the high-end destination RV parks, because that's a different business and it's a more cyclical business. And that's a business where I went to investors and I said in 2018, I said, hey, I think we have something here. And but by the way, mobile home parks are very recession proof. There's not much volatility. Now, if you're out there trying to buy good companies, let's say in the stock market, you want some volatility because you need them to jump down so you can get them for a good deal. Well, that's a problem with mobile home parks, is no one's really desperate to sell them. Typically, a poorly ran mobile home park, they're still making money. So that's kind of the great thing about mobile home parks, is the challenge of being able to find a good deal on a mobile home park. So I thought, okay, well, RV, it's a little bit different business, mobile, more similar to the hotel business. So let's build a business and let's figure out how to be good operators so that we can wait for the turn in the economy. We'll make less money on our existing properties, but we'll be able to buy a bunch of stuff up. Well, a lot of people started thinking the same way. And it's funny, like if you think about different investments, if you thought about it, there's probably a bunch more people that thought about it. So then the prices on these RV parks I was no longer getting for 7.5 to 9 caps. So, it just slowed down our buying, and we didn't buy, we bought more like one a year where we were buying 30 mobile home parks a year. So because the mobile home parks, people are very focused with cap rates. And I'll give you a kind of an example now, because everyone's very focused on interest rates right now and cap rates. And why aren't the cap rates a lot higher? Because interest rates are higher. If I'm going to pay a 6.5% interest rate, I want to buy a park for 7. That's not going to happen. So the issue, like I'm buying, I've already closed a couple of deals this year. I'm buying another park that's about 3.75 cap rate. Why would I buy a 3.75 cap rate? Well, because I own 2 other parks next door. And those other parks I own next door, I made them a lot nicer than when I bought them, but they're not as nice as this one I'm buying. And the rents are $150 more. So if I know that if I can buy the nicest park in the neighborhood and I've got $150 of lift, and then on top of that, there's about 30% vacancy. So if it's in a market I know I can bring brand new manufactured homes into and fill those spaces, and it's all direct build, gas and electric, city services, that type of thing. So now you have this beautiful park with upside. So does the cap rate matter as much as the upside in the deal? And when we look at a deal, we want to say, okay, this park here, 100 space mobile home park, we're going to buy it for $10 million. And maybe it's a 200 space park. So we're going to buy it for 10 million, and we're going to basically solve 5 problems to make it worth a $15 million park. And so do those problems exist? Is the park already stabilized and there's nothing we can do? So can we go in there and properly pass through the utilities? Can we fill any vacancies? Can we make the park look way more presentable and manage it more professionally? And then solve any band-aids by, fixing water infrastructure or the roads or trees or anything like that. And then we take our time to get to the market rents. We don't rush the market rents. Our business does have a bad, we get beat up in the news and there's lots of buyers out there, lots of real estate syndicators out there in the mobile home park world that'll go in and they'll do these $100 rent increases. And the truth is, you can get away with it in many, if you don't care about your reputation, which, Buffett says, it takes a lifetime to build your reputation, and you could basically, it's very quickly you can ruin it, right? So the challenge is, again, the beauty of the business is you're dealing with a captive audience. These mobile homes are not mobile. It's cost tens of thousands of dollars to move the home from that space to somewhere else. They are stuck there. That's the beauty of the business. But also there's a responsibility with the owner. So you have to have a relationship with your tenants where it is at the end of the day a partnership, where you don't want to suck equity from their home. You want them to always have equity in their home. So you don't want to be too aggressive on the rents. You want to take your time, get it to market, and then have fair, year-over-year rent increases. So we look at that. And a lot of times the number, there's all sorts of different metrics that we look at. And a lot of it has to do with, so like a 2-bedroom apartment, half of a 2-bedroom apartment, it's usually true that that's probably what the space rent should be in any given market. So, if it's $1,200 for a 2-bedroom apartment in that market, probably your rent could be $600. So if you're buying a mobile home park and the rent's $400, you could spend, you could say, okay, well, in 5 years it should be $700. So figure out how you get to $700 in the next 5 years and do that in a responsible way, while spending money on the properties.
Hey, Eli, we have one person who apparently has been to your park down in Southern California, and she says that it's awesome.
Oh, in BGO Springs. Hey, I love that park. That's like, I go there for like, we'll go there with the family for Thanksgiving. A lot of it, our investors will go there, play golf, and it really is well, that's cool. Well, thank you.
Hey, we've got one person who, towards the very beginning of the question, actually, it's John Doe, the infamous John Doe, who I still don't know who this person is, but they usually ask great questions. Was that John Doe laughing? Oh, I missed it. Okay. Anyway, the question is, you're 45, you've been buying for 23 years. How did you, at the age of 22, have enough capital to buy your first mobile home park?
Well, the very first park that I bought, so I started out as a mobile home dealer, selling mobile homes in other people's mobile home parks in the Bay Area of, basically UC Davis. So I went to UC Davis, and I wasn't very good at school. So it was easier for me to sell homes in a mobile home park than read a textbook. So between that and then starting the dealership in the Bay Area, where we would buy homes in parks in the Bay Area, in like Redwood City and Daly City. I'd go in, I'd pay $40,000 for a home I'd throw away, and then I'd take that home. And then I'd buy a brand new home from the factory back then for $40,000. I'd spend $20,000 setting it up. So I was flipping homes, revamping the parks with new homes, but I'd sell it for like 150. So I'd make $50,000 chunks. But there's no tax efficiency, and it was very capital intensive. So it was a very profitable business, but it had those two downsides. So actually, up in Northern California, a broker helped me find a park outside of Oroville, little 39 spacer. I bought for $300,000 with $60,000 down. She seller financed the rest, and all those old homes that I was taking and throwing them away were actually in pretty good shape. So I brought them up there. It was kind of like an older, not great kind of drug park. I went in there, cleaned up the park. I'd wake up at 3 a.m. in the morning, pick up the crew from Redwood City, drive, I don't know what it is, 4 hours up to, and we'd work for like 3 days straight. And we'd basically set these homes up. And while we'd set the homes up, we'd fill up the spaces, make the park nicer. So we filled up this park within 2 years, but we'd sell the homes for like $19,500 with $2,000 down and 14.5% interest back then. So we actually built a note portfolio of about $150,000, earning 14.5% interest. So I learned kind of the note business at that time too. And then we increased the value of the park in less than 2 years by filling it up, and we refinanced it. I didn't really know what I was doing. I got a I think $450,000 loan. And then, but got all the money out, and then took that money and went and did another one. So initially it didn't take a lot. But even the dealership side of the business, which was capital intensive, I literally went to everyone I knew and asked for money. And back then I didn't have a whole lot of people that would give me money. I have a cousin. I didn't have any, really the only family I had was one cousin that lives up here. And I don't know if he believed in me or he just is a gambler. But he gave me $20,000 off of a credit card that he was able to pull off a credit card. So he gave me like a credit card $20,000 check. He's like, "Yeah, sure, let's try it." And I was paying him like 20% interest. But he's invested. I actually just took him on a surf trip. He's 10 years older than me. He's been investing since then, just reinvesting every single year, and it's just been kind of an awesome thing to see, both his and my wealth just keep growing. And yeah.
All right, we've got a number of questions here, but first I have to comment, Eli, also. I'm also 45 years old, and I also went to UC Davis. So we were probably on campus at the same time, I would imagine. I'm curious, what was your major? Where about campus did you hang out?
Well, it was mostly tennis.
Okay. You were over by the dorms area, by Trocero.
I didn't. Well, I went to 2 years at JC at Foothill in Los Altos, and then I transferred over. But I actually broke my ankle, so like my whole, if it wasn't for tennis, I wouldn't have got it in. You guys are smarter than me. When it comes to the school stuff. Yeah, it's
Well, always great to meet somebody from UC Davis. Glenn is asking.
I might have a sweater from there. That's all. That's my biggest claim.
Yeah.
Since I didn't end up graduating.
I've been back exactly twice, so it's kind of in my past too. Let's see. Glenn is asking, are you holding long-term and cash flowing in perpetuity? If so, are you just syndicating and fundraising constantly to buy 30 properties a year? If not, what's your exit strategy to finance the next opportunity?
Yeah. So exit strategy, there's another quote, I wish I could find it, but and most people won't like this, but basically when you sell something, it's an admission to making a mistake. The saying is something like that. So in other words, if you bought the perfect business, you'd really never have to sell it. So for example, that first park, I refinanced it. I got all the money out plus another chunk of money, right? And then what happened after that with that same park? Well, I refinanced it like 5 years after, because I refinanced it in less than 2 years. And then 5 years after that, I refinanced again and got a $1.2 million loan. So if you just keep harvesting the properties because their values keep going up, and they don't go up because some magic or anything like that. They go up because the supply and demand is 100% on our side. So if you're in a business where rents are going up between 2008 to 2012, occupancies are going up between 2008 to 2012, like the recession is not impacting it in a negative way. Why would you sell that business? So now I sold an RV park, a high-end destination RV park that I hated selling. And now we're trying to deal with, finding the replacement property for it. We bought it for $11 million in Zion, less than 2 years ago. And we sold it for what, 19 million or something. But that's, that was an RV deal, and they're building 1,400 spaces in that area. That's not a thing with mobile home parks. So if you have a standard traditional mobile home park, manufactured home community, trailer park, if you have those, every year it's going to be worth more. I mean, I'll get offers. There's a park in Idaho that I've just gotten insane offers on, that I bought in 2019. And also think about it like this. We've got so many parks that we're refinancing a park. We just closed a refinance today in Michigan. I hate Michigan. I don't want to own anything in Michigan. Sorry if anyone's from Michigan. But we own several parks there because a mobile home park still makes money, and people need affordable houses in all these places. So we're still getting Fannie Freddie loans at like 6.1%. So why wouldn't we continue to harvest these things? So if every quarter you're harvesting a park and there's a big chunk of money going out to me and other investors, our problem isn't that we need to raise more money. Our problem is we need to build a team that can continuously find good places, and like that we can, find parks at fair prices that have good upside to continue to reinvest the money. And that's the vehicle that I built with with the Boita Group. So I've even invested my own money, and really in the last 9 months, I've increased our payroll over $2 million building the team so that we can keep finding good investments for my money and my investors' money, and keep keep doing that, and be able to execute on the game plan. So people are addicted to selling. And the other thing I would they almost think that they didn't really have a win if they didn't sell. But if you refinance, all your money's out, 100% of your risk is gone. Why wouldn't you keep it forever if you thought over the next 5 years, 10 years, 20 years, it was going to be worth a bunch more? We've got parks that I've owned for 15 years. I've got one in the desert that I've refinanced 3 times. I've harvested that baby 3 times. And the timing worked out where actually, this was about 1.5 years ago, the interest rates were so low and it was interest-only loan that I pulled another $2.5 million out of this property. It was my 3rd refi, every time we pulled big chunks out. And my payment was $4,000 less a month. So that's not going to happen as interest rates go up. It's going to get, more difficult, and it's more going to be more realistic to our original pro forma, which always shows a higher interest rate, closer to 6.5% refi and a higher cap rate on valuation and stuff. But the point is, when you sell, what you're doing is you're cutting your flowers. You're basically just taking off the top of your flowers, and you don't know what's in the bush, right? You're going to take that money, and you don't know, so you really have to. And the other thing I would always challenge each one of you is, you go find it. You got such a great opportunity. You can find the money. You don't need to sell something good to go find the money. You can parade what you have that's good and say, look at what we've done, and you could find the money. So, I think that your wealth will grow exponentially more if you don't sell. Just don't tell anyone that I'm trying to buy stuff from.
I was gonna say, Elias, if you're ever looking for money sources, there's a couple of people in the chat that said they'd be very willing to write you a $20K check for 20% interest. All right. There's another question by Glenn about park-owned mobile homes. Do you engage in owning any of the homes yourself, or what percentage of them tend to be owned?
Yeah, the goal. So the goal with mobile home park investing, and the reason we do mobile home parks and not apartments, is so that we don't have to go inside the home and fix stuff inside the home. We don't have to do like when the air conditioner breaks, we don't have to fix the air conditioner. So the perfect park is a manufactured home community, mobile home park, that is 100% tenant owned. And typically that's going to be an all aged, so you always have a market for it. But to answer that question, there's plenty of parks that I'll buy that have a ton of park-owned homes already there. So I look at the opportunity, and I've got a program where we go in and we'll sell the homes at a discount to the people that are already renting them, and we'll put in a deal where they can't move the home out of the park, but we'll also adjust their space rent from $350 to $475, because the banks want to see that the space, they're going to value the park off the space rent. So again, having this checkbox thing of only buy, because most syndicators in the mobile home park world, well, we don't want to buy parks with park-owned homes, and they're right. But what's the opportunity? And can you basically get to that? So can you make that? Can you convert that to all park-owned homes, all tenant-owned homes? And if you can, then and get the bump on the space rents at the same time, then there might be some great opportunity there. Now, there's other markets where the problem is the cost of these homes, the brand new homes, so there's huge demand for housing, but the problem is you need to be able to sell a home for $59,000, not $89,000, or not $89,000, not $150,000, $89,000, right? So the challenge there is you can get the rental. So if I bring in 50 brand new homes and fill up that 150 space park, and there's demand to fill it up as rentals. So we actually have a program where we go in and we'll convert after a year. We'll do this down payment assistance program that we work with our lender on and convert those to buyers. So the answer is, if you're okay buying maybe one deal a year, one deal every 2 years, then you stay away from park-owned homes. If you want to be a really great operator and you want to find opportunity, then you get really good at the dealership business. I mean, there's what's that real estate guy's Lindemann, or he says that to be a great real estate guy, you got to be real estate first and then finance. Well, you have a lot of finance people get into the real estate business and they'll get themselves in trouble. Peter Lindemann, I think.
Yep, Peter Lindemann.
He said that several times. So when I heard that, I thought, with the mobile home park business, understanding the dealership side is the key. Because if you can keep homes filled, if you can bring homes, get them set up and get them occupied fast, if you understand the dealership side first, that's going to make you a better operator. So it's the dealership side, it's the real estate, and then it's understanding the finance.
Ashish has a question that he's going to take himself off mute and ask.
Yeah, hey Eli. My name's Ashish. I'm an investor with Boita many years ago, and I got to know Chris Lemos pretty well. And when I invested, you guys promised me a few things, right? You said, hey, it's going to be 4% first year, 6% next year, 8% third year. You promised me for every dollar I gave in, I'd get like $1.60, $1.80 back in accelerated depreciation, and you delivered on all of it, right? Which was amazing. It was one of my best investments. The reason I stopped investing with you guys was a couple of reasons, right? One, you stopped offering the single park deals where you started doing a fund, which wasn't a big deal, but it was the complexity of taxes, right? So, I asked, hey, why don't you guys do like a REIT blocker, do an LLC with a REIT blocker? I get a 20% discount on my taxes. I get a composite K1. I don't have to file state taxes. And do you guys know, do you know why you guys haven't done that yet? Just from a tax complexity, because from an investment standpoint, right, this is an amazing asset class, which is why I was hoping to bring you in to this club.
Well, as far as the accelerated bonus depreciation is so major with this asset class that
it's amazing.
So most people aren't having any tax issues or needing any other special vehicles to even so basically everyone that continues to reinvest doesn't have any sort of tax issue. So if you're grabbing, if you invest $100,000 a year, and if you did that for the last several years, you probably picked up on average $120,000 negative on your K1 just from the accelerated bonus depreciation. So if you had all that, then in most cases the filing is going to be such a piece of cake. The reason we went away from the one, so yeah, I'm thinking that you were in Clover Ranch, right?
Exactly,
yeah.
Right.
So Clover Ranch was unique. In 2019, I started doing a fund, and the issue was my money was getting bumped from deals for several years because as we were refinancing, I kept trying to satisfy the need for investors to get into deals. Well, I wasn't getting in enough deals with my own money, right? So I used my money to build a team to be able to source deals all over the country and manage deals all over the country. And I talked to a lot of investors. I said, well, what if we did this? What if we all put our money in the fund together? And there's no waterfalls with the fund. And then I look at 1,000 deals and I try to find 20 or 30 deals that make sense. Mm-hmm. And the fund will invest in those deals. And we're all side by side like that. So, and that's how we did it. Clover was weird because one of my investors actually was a big fund investor, and he was the one selling it, and so he couldn't. It was a commingling issue because it wasn't 100% his deal, but he was in control of it. So because of the commingling, I had to raise the money outside the fund and do the deal outside the fund. So you had that opportunity to get in that one deal. So that deal was great. The problem with that deal is we sold. We sold because it had a typical like real estate structure where I charged acquisition fees, disposition fees, asset management fees, which I don't normally do. So it was a bigger split for the investor. But the whole way that it was set up, it incentivized me to buy it and to sell it. I mean, I was going to buy it anyway, but that's the typical real estate syndicator. They get paid to buy stuff and to sell stuff. And when I looked at how the waterfalls worked on that deal, and because when we raised with CrowdStreet, to be able to raise whatever it was, $6 million in an hour on CrowdStreet, you have to keep it super basic where everyone is used to this structure. Well, that doesn't mean that structure is good. It just means people are doing that dumb structure. Mm-hmm. So our structure is the investors get, it's a lower pref and bigger split, but the investors get with no fees, and the investors get 100% of their money back before we make a dime. And and then after 100% of the risk is gone, that's when the split happens. So I'm only incentivized to buy stuff that I can actually get to the finish line. So when I looked at that specific deal, it was a struggle for me because that's a beautiful park. I mean, we sold it for, it was like 33 or 36 million plus all the homes. They assumed all the homes, and we bought it for like 12. And I even have a cool story on how how I ended up getting that, because I was surfing like with the guy and another guy that had it under contract, one of the biggest players in the business. They wanted $1 million price reduction, and they were pissing him off. And he said, "Forget this guy. You should buy this." And he talked me into it, and I'm glad he did. So, but the problem is, I guarantee you, 5 years from now, 10 years from now, we wish we would just refinanced it, gotten all your money back, and you'd still be collecting quarterly checks from that thing.
Mm.
Because that's like, when are we going to replace, in a good location in Georgia, which is growing like crazy, a 330 something space, beautiful mobile home park? Like, they're just not building them anymore, and that's where it gets tough for me to sell. And so the structure and incentives matter. So I found myself in the normal situation where most real estate syndicators find themselves, where it benefits them more to sell. So that's kind of, but so you really have to look into the fund. The fund model. I think that, and maybe the gentleman you mentioned, I might be able to offline here answer the tax stuff with our CPA a little bit better than he'd be able to with you.
Okay, so Eli, what are you offering now? Like, are you still raising money? Do you still have funds that you're raising money for? And are you open to investors?
Well, Daniel, do we want to talk about that now, or do we want to?
Yeah, let's bring it up. We do have one question maybe we could hit first. And Prolet is asking, what are some of the red flags that you look for when evaluating a mobile home park? And then we can go on to the question of funds.
Yeah. Yeah, and one of the things, the notes that I was going to talk about is the predictability of cash flow is strong. Like, being able to say, if I solve these 5 problems in 5 years from now, this will be the cash flow, right? So being able to value these things is typically easier than other investments, other asset classes. So there's just tons of whether it's you could name any other, to be able to say that the rents will most likely be this number 5 years from now. So that's all great. The challenge is the operations are tough. The dealership side of the business is tough. So how much of that do you have to deal with? Fixing the infrastructure in today's environment where there's not enough, so that the operations, all the laws on evictions are different in every single state. There's rent control issues in a few Western states, even a few other states. So the management side is tough. And to do it well, you really need a big team of specialized people that understand those markets. So that's something that we definitely are very kind of careful of. When we're adding on properties, what markets are we good at and what are we not? Let's see. The last thing that you asked was.
What are some of the red flags when you're doing your due diligence?
Okay. Utility infrastructure, if it's private utilities, can we actually fill spaces?
Do you tend to favor whether the water's connected and the sewer's connected to the city, or whether they have standalone?
Always.
Yeah.
But that doesn't mean no. That doesn't mean don't buy. It just means that you need to have proper reserves and you need to get it for a big discount for it. So the other thing is, there's certain parks that are just going to be more capital intensive than others. And I don't, without running through, like pictures of 100 different deals, basically I have kind of a knack for that. So you have to properly, like, trying to underwrite, like, certain parks are just not going to cost that much to operate, and other parks are going to cost way more than you thought to operate. So kind of looking at that. It's funny because it's like, oh, look at all the extra land that we're getting on this deal. Great. If you can give that land away, get rid of it. And that could be the case. Maybe it's not the case, but the point is, if it's not producing income, it's just an expense, right? So that's what comes to mind when you ask that question.
All right. Do you want to share your screen for the fund?
You know what? I don't even have it. Do you have it?
I do.
Yeah, you can share or just have everyone so that they can grab it or stuff. But I'm not really. Yeah. So this you guys can get. This is the 2023 fund. We are. Last few years, we raised a lot of money as we found deals, and that's what we're doing now. Our deal flow this year is not what it's been in the past. It's not that we're not making a crazy amount of offers. There's it's funny when we look at deals, it's like there's literally like two $35 million deals that were small portfolios that we missed out on. But we didn't miss out. We held to our price. So we're holding to our price on so many different things.
How's the liquidity in the market right now? Yeah, are you finding it difficult to finance any of the deals?
No, the interest rates are, well, so if it's a Fannie or Freddie quality, then you're going to get like high fives to low sixes.
Yeah.
And then if it's not, all those normal business banks that I do a ton of business with, they're a lot more expensive. Now they're 6.5% to 7.5%. So when we were even looking at some deals where, okay, well, let's just pay cash for them. Again, if it's a $10 million deal and there's a clear path to make it worth $15 million in 5 years, then we just want to do the deal. We're really focused on the price that we pay, because that I cannot change. Once I pay that price, I'm stuck with it. I'm not that concerned about the interest rate. So the interest rate's going to change. I have no control over it, and when it goes down, we'll make a bunch more money. So, but right now, I wish I could tell you guys that I have a ton of deals under contract and we're raising a bunch of money, and that's just not the case. So what we're doing is we've got a team member here, Eric Resnick, which handles all the investment stuff. And you just shoot us an email, let us know that you're interested and how much and your timing. And he basically calendars it. And assuming that, every month, we're able to close the deals that we're hoping to close and get more under contract and everything looks good, then when it's your turn, you get to come in. So that's kind of, yeah. So this year, and I'll give you an example. In the previous years, our target equity raise was, we'd always put 50 million in here to go out and buy 120 million or 150 million, whatever. And we'd end up raising 100 to 130 million and go buy 250 to 300 million of deals. That's not going to happen this year. This is going to be a lot more accurate.
We have Gene in the chat who's asking about the LTV for these loans. He says that he's heard that banks are requiring around 35% down right now. Has that been what you've seen? Well, that was a few. I mean, the loan to value has nothing. It's all about the debt service coverage ratio. So most of the time, what you're going to buy, like I was explaining, that I'll buy a 4 cap all day long, even with a 6.5% interest rate, if there's upside, right? But that means that I'm putting like 50% down, or I'm putting 55% down. I mean, there's enough upside where I might pay cash. So it's more likely that, I mean, if someone's coming to you and they're paying a 6.5% interest rate on a deal, and
and it truly cash flows at a 1.35 DSCR with 35% down, you should jump on that deal, because that's they got it. That's just not a normal market deal. Which,
There's a question.
Everyone gets. We'll easily get one or two of those a year. I mean, that's just the luck of the hard work. But that's not. Our typical deal is going to be closer to 50% down in this market with the interest rates where they're at.
There's a question about do you pass depreciation on through your fund?
Yeah, so 100%. Now, the way that it works is if it's a non-recourse loan, the IRS allows you to take, for the investors to get 100% of the depreciation. So let's say we buy a $10 million park, and with that $10 million park, we put $4 million down. And there's actually a slide on this. Yeah, keep going. Keep going.
Is this it?
No. Keep going. I think it's that one.
Oh,
Yep.
This one up here?
Yep.
Okay.
Yeah, so figure, let's say you put, well, this says 3.5 million down. It's more likely you put 4 million down, but let's say you put 3.5 million down. And so on that $10 million deal, you don't depreciate land. So on average, land's going to be about 20%. So then what's left is $8 million. Of that $8 million, let's call 500,000 of it is going to be the buildings. So we put here $150,000 for like a park-owned home or a old home that the manager lives in. So that's going to be 27.5-year depreciation. After that, maybe there's a laundry room, clubhouse, office, call that $350,000 of value. You're going to divide that in 39 years, right? So those two, you're not going to get much for. But what's amazing with this asset class is we've always taken 75% on average of what we buy a park for, and we call that infrastructure. That's the utilities and the roads. So that infrastructure is valued at $7.5 million. So with the tax laws changing, so they just reduced, it used to be 100% of all 20-year depreciation you could take upfront in one single year in that same year. So now you can only take 80%, and 20% that's left, you have to get, you're going to get in the normal 15-year depreciation schedule. So instead of getting, so when you invest the $3.5 million, you would get last year, you would have gotten $7.5 million loss. This year, you're going to get $6 million loss your first year. But it depends if the loan is a non-recourse loan or recourse loan. So remember, I'm incentivized to buy a good deal that I can refinance out and get 100% of the money back to the investors as quickly as possible. So because I'm not just chasing depreciation, there's many parks that we'll buy that Fannie and Freddie and non-recourse lenders will not give us a loan on. We got to go to the regular commercial banks. So that means Eli has to sign a personal guarantee, which Eli is more than happy to do. So if I sign a personal guarantee, then the IRS only allows the investor to get a loss up to the amount that they put in. So now in this scenario, the investor would get a $3.5 million loss. Okay. But then in the non-recourse, they would get in this scenario, a $6 million loss. So your percentage of loss would, it's like 180% negative, right? On your K1, and that's awesome. Unless you sell it. That's why we don't want to sell. So that's another reason.
Ashish is asking, with as few parks as you're buying, or at least with the volume of parks that you're buying going down now, do you still anticipate returning investors capital in 4 to 5 years and providing them with the check in perpetuity after that?
Yeah, I think in this slide we put more like 5 to 6 years. We reduced the IRR, a little bit. So we're kind of lowering expectations a little bit, but again, we're holding strong to our prices. So So, you know, that's why we're buying less. You
Yep.
know? So, yeah.
All right. Are there any other
Sorry.
questions from people? Glenn?
Yeah, sorry, I'm not sure I quite caught the answer to that. I got the IRR is different, you know, given the, you know, where we are, but your assumption for investors is capital return in X years, 4, 5, 6, whatever, and a perpetuity payment thereafter.
Right. Yeah. So on this slide, I think it says 6 year refinance in year 6 instead of year 5, as previous years were projected. So, and remember, the fund's investing in a bunch of different deals. So each deal, you know, we might have a deal that we refinance in year 2 or year 3 or year 4, and then with the majority happening between basically year 4 to year 6, and then there might be some stragglers after that. So does that answer your question? Yeah. But the whole goal is to refinance. So now the park is stabilized. And then even though it's stabilized, we're still increasing the value year over year. So the cash flows are still growing. So quarterly distributions will still, you know, keep coming and coming and coming. And then what's really going to happen is, you know, if we refinance a park, then 10 years after that, we're going to harvest that baby again. So over time, it's just you're going to get more pops on the refi. And that's, you know, that's also why it's difficult to get in as an investor, because we have a lot of investors that always reinvest and they're always getting refis.
All right. On my side, Zoom is crashing on my system, so I don't know if we're all going to be booted out if I leave. But so let's take this opportunity to thank Eli for coming in and talking to us. Could you all take yourselves off mute and thank him for sharing?
Hey,
Thanks,
Eli.
Eli.
Thank you.
Thank you, Eli.
Thank you, Eli.
Thanks,
Thank you
Eli.
very much.
Thank you.
All
Happy
right,
as I could.
Thank you, Eli. It's been really informative, and mobile home parks are a great investment. Thanks for sharing with us.
All right, guys, have a great day.
Bye.